Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Hi, welcome to Wall Street Wrap-Up, and hope your week went well. I'm Andre Laborde. Our goal is bringing Wall Street to your street for this Friday, March the 5th, 2021. Well, tonight we've got some advice and we've got some good news. The advice is you may not want to look at the best time to look at your 401k at this moment. That's the advice. But the good news is tonight we've got a great guest. We've got the right person to tell us what's going on in the markets. Coming up, we'll be talking with Terry Dufresne, Managing Director of JP Morgan's Private Wealth and Head of Investments. But first, how did the markets do this week? Well, the Dow Jones Industrial Average ended the week at 31,508 points, up 582 points for the day, and ended up 1.8% for the week. The S&P 500 closed today at 3842, up 74 points for the day and up just barely 0.8 of a point for the week. And finally, the Nasdaq finished the week at 12,922, up 198 points for the day and down 2% for the week. All three indexes ended the week snapping a three-day losing streak. The Dow posted its best weekly performance in 4 weeks, and the Nasdaq sees its second straight weekly loss. The Dow, the S&P 500, and the Nasdaq all closed near session highs. Well, let's get to our guest tonight. Terry Dufresne is Managing Director of Wealth Management and Head of Investments at JP Morgan Private Bank. Terry, welcome to the show and glad to have you.
I appreciate it, Andre. Thank you.
Okay, glad to have you. Well, I'll tell you, this is the perfect week right now. Just out of curiosity, with the way the week has gone for this week, what are you advising your high net worth clients buying right now?
What we're looking at right now, Andre, is really just truly what's happening beneath the surface of the market. And you are seeing somewhat of a shift now away from what worked last year, which was going to be the higher price earnings, higher, PE multiple type stocks like the tech stocks, obviously the ones that you're all very familiar with, and they work quite well. And again, we all familiar why that happened. That's because you just had a lot of people, working from home, using a lot of the resources, a lot of services that these stocks provided. Now, as we're getting a bit closer to coming out of COVID, getting a bit more people vaccinated, and it looks like the economy is starting to open back up a bit more, it does seem like the focus of investors is starting to shift more to more cyclical stocks that would benefit from a more broadening expansion of the economy.
Well, how do you see? Do you see the next 9 months from now till the end of the year? Do you find that to be good for equities?
Yeah, Andre, we actually do. I mean, if you think about what's actually on the runway right now by way of liquidity, and right now we're seeing really 3 sources of liquidity out there outstanding. If you look at the savings rate of Americans, and this number came out the other day, is the savings right now is at 20% for Americans. It's never been that high. In fact, it's probably been more along the lines up to the low of the single digits. And as far as money, as far as the amount of money it is, it's close to $2 trillion. So that's going to be one source of liquidity. That wasn't there this time last year. The second one is that a lot of corporations took full advantage of the ultra low rate interest rates that the Fed provided to us right after the crisis, and therefore there was a lot of debt that was issued back in March and April and June of last year and May. And so as a result of that, there's probably about $1.5 trillion of liquidity there that's not yet be spent. And then finally, we all know that there's a COVID relief bill coming from the administration. And the number is going to be somewhere between 0 and $1.9 trillion. But the point being, it's going to be a lot of money. So those 3 sources together, we could put our eyes on anywhere from, say, $5 to $6 trillion of liquidity. Now, not all of it's going to be spent, but a good part of it will be. And so that money is going to find its way back into the economy. And if that happens, of course, that means economic activity is going to increase, and that's going to lead us way to higher earnings. So the outlook that we've got, Andre, is that for the full year of 2021, we actually think it's going to be probably one of the better years that we've had on record.
Interesting. Well, do you find, with the stock market, what happened this week, in fact, we even touched a little bit about it earlier, was that because of the Treasury notes, where it had the 10-year Treasury notes was getting to at 1.5%, that when the yields go up, that means more people are getting out of the treasuries. Well, my first thought was that, well, if they're getting out of treasuries, then they're going into equities. But you brought up a very good point that I never thought of. You think it's going right back into cash and not in stocks?
Yeah, I think that the people who are actually holders of treasuries right now, who actually own fixed income obligations, it could include treasuries, corporate bonds, anything like that's got some sort of a note attached to it, or some kind of coupon attached to it, is that they're reassessing the risk of holding on to that instrument. And so when you bought that 10-year treasury earlier this year and the yield was, they call it about 1%, and now you're looking at it being about 1.56%, you're making a risk assessment. Should I still continue to hang on to that treasury? Because if rates continue to rise, I'm going to lose value in that instrument. So there's going to be that risk assessment whether I should continue to hold on to that investment or that particular U.S. Treasury. Now, some of it finds its way into cash as a holding period, waiting for things to settle out. But some of that money also finds its way back into the equity markets. And I would suggest it's going back into more of the cyclical or the value trade. And that's why you saw banks and also energy stocks do so well to start the year.
And usually when interest rates are low, banks are doing better because they can make more money that way. Is that right?
Actually, the other way around, Andre. If you
Really?
think about
Okay.
it, banks make a lot of money off of what's called the net interest margin.
Okay.
And so we pay you money on your deposits, and we also make money on your loans. So we lend short and borrow long. And that the money that we're paying on deposits today is very, very low interest rates, but the money we're receiving in from the loans that we make out, that's that spread that we make. So if rates are going higher, is that we've got the ability to price our loans up higher, so our net interest margin should increase. So it's a possibility of net interest margin going higher, plus economic activity picking up, and of course banks benefit from economic activity increasing.
I see. Well, this week, Jay Powell, the head of the Federal Reserve, gave a talk to the Wall Street Journal, and he tried to make sure that everybody knew that they were going to be wanting to keep interest rates close to zero, and to kind of make sure to calm the markets, which did just the opposite because they were worried about inflation. So, do you think the Federal Reserve will be keeping interest rates close to zero for the foreseeable future?
Yeah, in fact, we've got we anticipate, or we're forecasting, that rates will stay at this level as controlled by the Fed probably well into 2022. Now, it may be that we've actually moved the calendar a little bit further up, so where it may have been late 2022, maybe now early 22, but we don't see any indication that the Fed is thinking about, and that's his famous quote. He's not even thinking about raising interest rates, because again, remember, his mandate is to provide for, again, control inflation for one, but also to think about unemployment. And we saw that the numbers come out today on the payroll numbers, and it actually turned out to be a much better number than expected. So that surprised the market, and like you and I talked about earlier, that would have normally been a good sign for equities because it meant the economy was actually continuing to grow. And I think initially out the gate it did, but people started reassessing what Jay Powell was saying about interest rates. And I guess he wasn't emphatic enough about his intention to keep rates for a lot longer. So therefore, maybe people hit the panic button and started selling equities. But as you and I both know, that reverses course about midday, and we ended up on the day about 572 points on the Dow.
Right. It turned from the way it started around 10 o'clock in the morning to the way it finished up at 2:30 or 3 o'clock was a complete different change from what it really was. So
Right.
it's kind of I guess the philosophy of the Federal Reserve at one time, we've even talked about this in the past too as well. You know, when you had Ben Bernanke or Greenspan, that whenever the unemployment rate was going to go lower to 5% or 4%, that automatically you knew that the interest rates were going to be going up. But they want to keep that at a 2% inflation or more, that they're not going to be following the same game plan, are they?
No, because remember, in the past, you're right, Andre. Their mandate is to provide for full employment, and that number's been debated over time. So most people kind of throw out a number of anywhere, say 3 to 4% as a natural rate of unemployment. So anytime you're going to dip below that, you're starting to hire that marginal worker, the one that maybe isn't as productive as the one you hired say a month or 2 months ago. And
Mm-hmm.
so therefore productivity starts trailing off with that last marginal worker that you've just hired, and that could lead to less productivity and perhaps higher inflation. The second mandate that the Federal Reserve has is to control for inflation. And in the past, again, past Fed governors have always, Fed chairman has always looked at 2% as literally being a line in the sand. And anytime that the inflation rate was above 2%, they use that as truly their indication to go ahead and start raising interest rates. And that happened, if you remember, Andre, back in the fall of 2018, when it did look like interest rates were on their way back up again. And then again, Chairman Powell started raising interest rates, and that's why we saw that fourth quarter sell-off down about 20% in 2018. And the market clearly told the Fed, you know what? There isn't any inflation out there. You need to hold back. In fact, you need to reduce rates, which he did.
That's right.
Today, fast forward, I think policy is much more about having a range instead of a specific point. So they are going to allow inflation to go above 2% for some time before they start raising interest rates, because they want to look at it more as being a range versus a specific point in time.
And I guess the cause of deflation is a lot worse than the cause of inflation, because they can cure the inflation a lot better, because of deflation would be much worse. So that's why they would hope to get it back up to a 2% range of inflation, right?
Yeah, remember, inflation is not terrible. I mean, we all remember, some of us remember, the times back in the 70s, the 80s when we had hyperinflation.
Oh,
And we had interest
12
rates,
and 14%. Yeah, exactly. Yeah.
Yeah, and that was a time where you may remember the term stagflation as well. We had stagnant growth with high inflation. Well, that's what people remember, and they want to try to avoid that. We think there's little to no chance of that actually happening this time around. So if you think about what, again, they're trying to control, again, is for moderate inflation. And remember, what is inflation? Inflation is the ability, or inflation is too many dollars chasing too few goods, and that leads to higher prices. Well, higher prices in itself aren't bad, because it means that there's a lot of demand out there, and therefore a person could increase the price for their product or their service and therefore make more revenues, which therefore translates into higher earnings. So I think moderate inflation actually would be welcome at this time.
I understand. Would you advise, like right now with the market, for about 3 of these days of the 3 of the 5 days was down, and it ended up today being very good. But do you advise to take, if you have stocks, to take profits off the table right now and sell some, or would you cash and make sure and get some stocks at bargain basement prices?
I think you really need to identify those buckets, Andre. And again, what we talk to clients about literally every day is that what's the meaning, what's the goal of the money you've got? And if you've got your money set aside to meet the everyday living needs, say that those cash reserves, and you got maybe another bucket that you identify as being sort of the intermediate need, that maybe 12 to 18 month money where you want to keep it a little more liquid, but certainly don't want to expose the risk. But if you've got that bucket where you've got that 3 year, 5 year, 10-year legacy type environment to it, or assignment to it, then I would certainly encourage people to put money to work right now. Because I think, again, as I said earlier, is that we're getting ready to enter into an economy in 2021, which is going to be really, really strong based upon everything we're seeing. Again, the economy opening back up. I just saw a news headline cross my desk just within the past hour that California is going to allow music parks to open back up in April. Mm-hmm. And so that's going to be, again, consistent throughout the system. You're starting to see a lot more travel data right now pointing to the fact that people not necessarily right now are traveling, but they certainly have intentions to travel. So look out. If you haven't made your plane reservations, your restaurant reservations, resort reservations by now, you better get on it, because there's going to be a lot of demand for that in the second half of the year. So I think that's going to translate again into higher earnings, and that should in turn translate into higher stock prices. One thing you're probably thinking about, as far as evaluation, is that yes, if you measure it by a traditional price to earnings ratio, it is a little bit on the expensive side. But to us, it's warranted, because you've got, again, such a really kind of nice growth path that we can see for 2021, and again, well into 2022 as well.
And kind of piggybacking on what you were saying, Terry, is that today with the jobs report that came out, one of the areas that really did very well was travel and leisure. The travel and leisure,
Yes. Yeah.
offhand, I know we've got it here, but it was one of the better. Oh, here we go, up 355,000. And retail was up 41,000. Manufacturing was up 21,000. But of the three that were up, travel and leisure and hospitality were great, especially for our area. That's good. Yeah.
And again, Andre, I always got to remind myself when I talk to clients about how bullish and just how optimistic we are. I need to remember where we live, and we know that two of the sectors that got hardest hit during the COVID crisis was energy, because the price of oil, energy came back down so hard, and of course the hospitality segment. So it's really encouraging to see people coming back to work in the hospitality, travel, and leisure, because it means that once more the hotels are opening up, the airlines are starting to fly, and people going back out to eat at restaurants.
I see. Terry, when you talk to clients, prospective clients, about where to put their money, you just talked about the energy. Do you get any worry or trepidation? Because these days you've been hearing a lot about EV, electric vehicles, or battery, or, you've got car companies now that are stating that they're going to be going all electric by certain dates, whether it be 2030 or 2035. What are your thoughts about the energy sector?
Yeah, in the near to intermediate term, Andre, I think that the fossil fuel business is still going to be well and intact. And you can see that today by the price of the oil, where it's at $66 a barrel. And I'll remind you, back in April, it actually traded negative. Remember that, because again, there was just too much
I do.
supply.
I remember that. It
And
cost.
again, there were some
Yeah.
technical. There were technical reasons for that, but it really did trade below zero there for a point in time. So demand is again once more picking up, but credit OPEC, they are keeping their members in line and keeping supply really constrained. So again, reduced supply, increased demand leads to higher prices right now on energy stocks. So I think the fossil fuel business for the next, say, intermediate, next 3 to 5 years is still going to be a very valuable or a viable component of anybody buys portfolio. Longer term, I think we all agree that fossil fuel is going to probably be at some time be not necessarily replaced, but certainly complemented. And the news is consistent. You point to a couple of companies out there. I'm very familiar with, for example, that Amazon is going to say that their fleet needs to be all electric by a point in time. Same thing with UPS. But interestingly enough, is that as well as energy has done this year on a year-to-date basis, that's how poorly that clean energy has also done. Clean energy is one of the darlings last year, one of the hotter sectors of the economy. And again, I think that people are probably taking some profits on that because they're starting to see demand pick up for fossil fuels.
I understand. Terry, we're going to be right back. We're going to take a message, a couple of items of what's going on in the news this week, and we'll be right back with again Terry Dufresne from J.P. Morgan Private Bank. We'll be right back. Terry, I have to ask you, what type of reaction and feedback did you get from clients or from even around the office water cooler about all the frenzy with GameStop and Wall Street bets? What was the feeling from your clients?
Yeah, and it was, first of all, they want to know what was going on.
Okay.
Right. And this is one of these periods of time where you get some unexplained phenomena that kind of works its way to the market. By the time you step back and say, what is it that happened, you kind of understand it. And what happened with those, what they call meme stocks, and you've already mentioned GameStop, you already know AMC Theater being another. And the one that happened this week was on Rocket Mortgage or Rocket
Right.
Corporation. And this is when you've got, Robinhood, or you've got these really trading platforms where you can trade for $0 commissions, for one, so you have easy access to the trading floor. Second, you've got cash in people's pockets, so you got stimulus checks that came in, and it's, again, remember my comment about the savings rate, and you got idle time because a lot of these folks were unemployed and they had some time on their hands to go out there and do some research and find some things to put money into. And so, to their credit, I mean, they did find stocks that had been heavily shorted, by some of the hedge funds, but also had very low stock prices. So the ability of the stock to go even lower was probably somewhat minimal. And so they had discovered that, and they started, a campaign, I would say, to go ahead and start buying these companies. Now that I would suggest, Andre, is not necessarily investing, because it certainly does not have any kind of long-term perspective whatsoever to it. I don't recommend my clients participate in that, because it's just too random as far as the kind of prices you'll get on the execution. And I think that overall it was interesting to note and to look at. But if you look at the effect on the market, the market kind of nodded for a couple of minutes and said, okay, that's interesting. But the overall price action did very little to affect the overall levels of the marketplace.
I understand. So I was surprised because of Rocket Mortgage, but this also kind of puts the ball back where at one time the hedge funds were sort of like the outlaws that were sent shivers down the spine of many of the equities. But now it's the opposite way, where you've got the, like you were talking about, the memes that with Melvin Capital, that they certainly rock Melvin Capital and others, with people buying GameStop or AMC, or those in Rocket Mortgage was heavily shorted. So that kind of threw things off. Yeah.
It did. And again, once more, is that the actual dollar amount that you're talking about, from the overall market's perspective, wasn't great, but it did create, some moments, I would suggest, within the hedge fund community about, what's going on here. But they quickly adapted to it as well, though.
I understand. Terry, we really appreciate it, and we hope you come back. Like I said, the way the week was going with Wall Street, I knew I had the right man at the right time to help kind of explain what's been going on. We appreciate you coming in tonight. Thank you so much.
Anytime, Andre. Thank you.
Thank you so much. That's Terry Dufresne. He's from J.P. Morgan's Wealth Management, and he also managing director of investments. We appreciate Terry for coming in. Well, some business items in the news this week. Did you ever find it curious when you looked up something on Google, you immediately started seeing ads for the same item or similar items? Well, Google plans to stop selling ads based on individuals browsing across multiple websites. That's a change that could have a major impact in the digital advertising industry and maybe even Google's bottom line. Google said on Wednesday that it plans next year to stop using or investing in tracking technologies that uniquely identify web users as they move from website to website across the internet. Now, instead, Google said its ad buying tools will now use technologies in development with others in what it calls privacy sandboxes to target ads without collecting information about individuals from multiple websites. Now, one such technology analyzes users' browsing habits on their own iPhone and computers. Well, the NFL is on the verge of signing new broadcast rights with media partners that could see Amazon.com carry exclusively many of its games. Television networks will also be paying as much as double their current rate. According to a source, new agreements could be in place as early as next week. The television deals for the league's Sunday and Monday franchises with Fox, CBS, NBC, and ESPN are likely to run for as long as 11 years. And ESPN's deal would go into effect after the 2021 season, while the Fox, CBS, and NBC agreements would kick in after the 2022-23 season. Now, the agreement with Amazon would result in a significant number of Thursday night games that's exclusively on Amazon's Prime Video platform. Now, those games would not be available on traditional television outside of the local markets of the two teams that are playing. And Walt Disney Company said this week that it will close at least 60 Disney stores throughout North America this year. The company said it would focus more on e-commerce while reducing the number of bricks-and-mortar locations it operates, usually found in shopping malls. Now, during the pandemic, consumers have increasingly shifted its purchasing more goods and services online due to the lockdown. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. You can write us at Andre at wallstreetwrapup.info. And if you keep it pithy and concise, we'd be glad to answer your questions. And now for a look at what's ahead for next week. And finally, an update on a story we did last week. We ended the show on toy maker Hasbro worried that they may offend someone of their toys, Mr. and Mrs. Potato Head. Well, a toy that was first introduced to the public in 1952, almost 70 years ago, with no complaints. Well, we thought we had heard it all, but then Disney, the company founded by Walt Disney himself, wanted to do a one-upsmanship of stupidity. So, Disney and their streaming services, which now carries The Muppets, has put an offensive content warning on The Muppet Show, forcing viewers to watch the warning before you can watch Miss Piggy or the Cookie Monster. But wait, now Disney, they didn't stop there. Disney also has now included warning disclaimers on Dumbo, Swiss Family Robinson, The Lady and the Tramp, Aladdin, Peter Pan, and the Aristocats. Well, now this past week on March the 2nd was Ted Geisel's birthday, born in Springfield, Massachusetts. What does that have to do with the Muppets, you might want to know? Well, to friends and family, he was known as Ted Geisel, but to millions and many more millions of children, Ted Geisel was known as Dr. Seuss. This week would have been Dr. Seuss's 117th birthday. Now, if he were alive today, I guess, and thankfully maybe he's not, to see how his work is being trashed by the counterculture who see things through a prism that just isn't there. Well, every year on Dr. Seuss's birthday, the White House and the First Family hold a Read Across America Day and celebrates Dr. Seuss to show that reading is fun. Well, this is the first year that the Biden administration has dropped Dr. Seuss. Why? Well, because now they say Dr. Seuss was a racist. Now, just a little bit of a brief history. Dr. Seuss was a liberal in his thoughts and feelings. He wrote against bigotry, and not in a subtle way. In 1961, he wrote a book called The Snitches that any 5-year-old can understand, but too difficult maybe for many 30 or 40-year-olds, and they may not be able to comprehend. Well, this week, Random House, the publisher of Dr. Seuss, has stopped going to press with his books, the first time in over 60 years. And eBay has stated that they will now discontinue selling the books that millions of children have enjoyed for over 60 years, all because someone got offended. Now, just so that you may know, you can go on eBay and buy My Story. Well, you may not know of My Story, but you know of the German term of Mein Kampf. Mein Kampf by Adolf Hitler is not just in English, but numerous languages on eBay. So you can buy that book, but not Green Eggs and Ham or The Cat in the Hat. That may be too offensive. And if someone is offended, anyone with this story, well, just get over it. Well, that's our show. And we hope you've enjoyed it for Friday, March the 5th. We will be back next week, and our guest will be biographer Walter Isaacson. Stay tuned for that. Remember, you can follow us on Facebook and WYES.org. So thank you for joining us for Wall Street Wrap-Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.